I'm Krug, CEO and publisher of the Center Square, the nation's second largest newswire, reaching 141 million Americans every day. My co-host is noted PhD economist Dr. Orphe Divounguy. Every week, Orphe publishes economic analysis across our national newswire. Every week on this show, I put that analysis under a little bit of pressure. This is Everyday Economics, primary source data, challenged in real time, translated and what it means for your wallet. We're recording this episode on Monday, April 6, 2026. Let's go to work. Orphe, hey, welcome back. Last week's job report hit and the headline looked pretty good. 178,000 on the payrolls. Unemployment ticked down to 4.3%. Your column this week says the details, however, tell a very different story. So let's pressure test it. The top line was 178, but you flagged that the labor force actually shrank by 396,000 people. Participation dropped to 61.9%. And the 3-month payroll average dropped to just 68,000. So walk us through why the jobs headline may be misleading. What's actually happening underneath the number?
Well, first, I would say, go back to the previous 2 months were revised downward. So we actually lost jobs combined in January and February. The employment to population ratio is moving lower. The civilian labor force is falling. The number of discouraged workers is on the rise. Which partly explains why the unemployment rate is not rising. So this break-even unemployment is around, break-even employment growth is around that number that we got. And so just enough jobs to keep the unemployment rate from rising. Let me add one more. Nominal wage growth cooled. It was 3.5% year over year this month, down from 3.8% the prior month, right? So if you adjust the wages for inflation, real wages, inflation-adjusted wages are actually now moving lower, right? So that's a problem. That's going to squeeze households. And of course, we're going to get the next big report. It's going to be the inflation report. We're going to see where that number goes. But ultimately, the gap is shrinking. You now have prices rising faster and potentially could start to outpace the increase in wages, right? That is not, I don't think that's a great jobs report. I think we're going to probably get more downward revisions, which is exactly what we've been getting. And so, yeah, that's the analysis.
Well, and you also pointed out that the marginally attached workers, and I want to talk about that, what that definition of like the marginally attached, that workers, that number jumped to 1.94 million. That includes 510,000 quote unquote discouraged workers, people who just stopped looking. On top of that, in January and February, payrolls, as you noted, were down. That number was actually revised by a net 7,000. So we're not just soft in March. We're retroactively softer than we thought. And at what point do these footnote numbers become the real story?
Well, they probably
or are we there?
We probably paid way too much attention to the establishment survey and don't pay a lot of attention to the household survey. Over time, the gap between the two surveys tends to close. And the big question is it going to look better when the gap between the two surveys closes? Is it going to look better and upbeat, or is it going to be looking worse, right? Reflecting more of the household survey than the establishment survey. And by the way, this establishment survey is not great either. I mean, we've had ups and downs, right? Consecutive months of big uptake, a big downtake, a big uptake, and a big downtake, right?
Yeah.
That does not inspire a lot of confidence. A lot of volatility in those numbers, a lot of noise in those numbers. It doesn't inspire confidence. By the way, we also have, since the end of February, we've been involved in this conflict overseas, and the conflict overseas pushed gas prices higher. Which, what do higher gas prices do for households? Well, it's unforeseen expenses, right? It's another expense that will likely absorb all of the fiscal stimulus. Like if you thought people were getting checks back from the IRS at the start of this quarter, if all of it is eaten up by the increase in gas prices, well, there's no stimulus to be had. And ultimately, you had an economy going into this year that was already cooling. And it means further cooling ahead.
Yeah, I was in Pennsylvania last week and was doing a fair amount of driving. I saw diesel at $5.69 a gallon in somewhat rural Western Pennsylvania. I mean, that's not a good number.
Wow.
I mean, everything that pretty much everything that we're picking off the shelves, whether it's grocery or retail, it got here on a truck, right? So,
Exactly.
Well, I'll tell you what. Last one on this. Wage growth cooled to 3.5% year over year. And that's down from 3.8% in February. Month over month, it was just 0.2%. And again, to go back to groceries, that barely keeps up with the grocery run. You've argued that wage growth is the real signal for whether workers have leverage. If wages are decelerating while participation is falling, what does that tell us about where workers actually stand right now and what it means for their household budgets?
Yeah, I mean, a nice report to look at is the JOLTS, and the JOLTS shows you the kind of job openings, and you can compare the number of job openings to the number of unemployed workers, people who are still in the labor force looking for work. You mentioned marginally attached workers; those are people that are not in the labor force but who want to work.
Right.
We would want to be able to
actively seeking.
They would want that, right?
Yeah.
That number is increasing. You have more unemployed workers than you have job openings, and you have more people out of the labor force who wished they could get the opportunity to start working again. That is a problem, right? And so that's why I'm not so upbeat about this labor market report. I also think with the Middle East crisis and the rising oil prices and the uncertainty that's out there, job openings are not going to be increasing anytime soon. Business owners are not going out there and saying, hey, we're going to open new positions and invest in 2026 and hire more workers. In fact, I mean, we're seeing, the biggest companies, the ones that were basically in good shape, shedding workers in the current environment. And so I just don't see that. I don't see that labor market rebound continuing in the months ahead.
Yeah, I mean, anecdotally, a good friend of mine who works in the recruiting space, I'd asked him, like, hey, what's it look like here in real life? And he said obviously they're still busy, but it's a lot of temporary to hire type employment opportunities that he's writing right now. And I mean, I think that speaks specifically to business owners and operators just kind of taking a wait and see approach.
Yes, absolutely.
Stretching out the opportunities. So I guess, to put a fine point on it, we've got a labor market that's not collapsing, but it's not reaccelerating. There's a quiet, losing of steam while everybody focuses on the headline. And that matters for every household making decisions about spending, saving, or whether this is the year to make a big move. So that's this week's Everyday Economics. This episode, anyway. Orphe's full column is live right now at thecentersquare.com. Read it, share it, and come back. We've got a second episode dropping this week, breaking down the inflation collision between tariffs and oil. You're going to want to hear that one. If today's episode helped you think differently about your money, your mortgage, or your next big decision, that's the point of the show. I'm Chris Krug, and thanks for joining us.